I'm not very knowledgeable about finance or what you guys do, and I'm not even sure I'm going to be able to clarify the picture that much for you on the economy, but I will give you my my sense of my analysis, at least, on economists are not good at making money, so you never take a prediction from an economist too seriously. Nevertheless, I think sitting in Delhi, of course, you see more, especially at this time of the year, you see more smog and less sunshine. So you can tend to get pretty gloomy about things. And, you know, of course, the latest monthly data is out on inflation, shows sharp uptick, and production, industrial production seems to have gone down. If you look at quarterly data, we had 5 bad quarters, and then we had one slight uptick quarter. And then the question on everybody's mind, of course, is where are we going to go in 2018? What's the budget going to do? I'm part-time at FICCI, and we just had the AGM where we had the Prime Minister come for the first time to FICCI. And of course, when you listen to him, you know, of course, he's not an economist or a finance person, but, you know, he has this very bold vision of the new India. And you get very inspired listening to him that, you know, under that kind of leadership, India is going to, over the medium term and certainly over the long term, do very well. We also had the finance minister yesterday and the defense minister, who used to be the commerce minister before Mrs. Nirmala Sitharaman. And of course, the finance minister's focus was much more on the next year, where he emphasized the need to get out of the banking mess and a focus on infrastructure. Anyway, let me step back a little bit. You know, when I was doing a PhD thesis at Stanford, I did a thesis on Indian inflation at that time, and we were a very closed economy. And my thesis came to the conclusion that because we were a very closed economy, any domestic shock, like a drought or, you know, bad rainfall, would hit us very badly, because we didn't have trade as a buffer to, you know, we weren't trading as much in those days, and therefore a domestic shock we were less able to handle. So every time we had a drought, food prices would shoot up, and, you know, it would drive up wages, it would drive up other prices, and then we would have a period of inflation. But when the shocks were more external, you know, global shocks, like, for example, some of you are too young probably to remember, but we had a very big oil shock in 1973-74, and it affected India much less than the rest of the world. But today India is in a very different picture. We are a much more open economy. Perhaps not as open as many others, but still we are, for all practical purposes, de facto a very open economy. And even our capital account, which is, you know, you are all finance people, so we've had gradual liberalization on the trade side, but we've still had a closed capital account. But for somebody like me who does open economy, macroeconomics, for all practical purposes, India is de facto fairly open on the capital account as well. There's enough inflow and outflow of money, short-term portfolio inflows, that while legally or de jure we are not an open capital account, but the amount of money that flows in and out of India, both into equity markets and into debt markets, and the blurb actually points to a figure itself that you have in front of you. We are, for all practical purposes, de facto a fairly open capital account economy as well. And I say this because I'll come back to it in a little bit. Now, when international prices go up, it has a huge transmission effect into India. In the last couple of years of the UPA government, we had global commodity prices going up a lot, and that hurt us. Inflation went up, growth came down. And then in the first 2-3 years of this government, we actually had the opposite. We had global oil prices dropping very sharply, food prices also coming down. Global inflation came down, and we benefited a lot from that. We had by IMF accounts, we had the economists call it a terms of trade windfall or a terms of trade shock. So we had a terms of trade windfall of almost 1 to 2% of GDP. Depending on your assumptions you can make, but IMF estimates we had a terms of trade windfall of at least around 2% of GDP, which is huge, right? And I think what's interesting is that 2017, despite the fact that we were still enjoying, relatively low oil prices, we were actually enjoying a fairly robust recovery in the global economy. India surprisingly did very badly. So we had a terms of trade windfall. India started to do well. So the 2015, 2016, our numbers looked pretty good. Growth started to pick up, inflation stayed down, and whatever the RBI might say about their policies, I think, international prices had a lot more to do with the decline in inflation than any monetary policy of the RBI. But what surprised me is that 2017, despite all these benign international conditions, despite the fact that oil prices remain pretty low, we didn't do so well in 2017. And partly, or largely, it's 3 major policies that cost us in 2017. One was very high real interest rates. 2 was the effects of demonetization from last November. And 3 was the GST, badly structured GST, and even very poorly implemented GST. So a badly structured GST would itself have been a bad thing, but then, lack of adequate preparation cost us a lot. Now, when I say very high real interest rates, what do I mean? The real repo rate in 2014, 2015 in India was about 2.5% on average for those 2 years. Quite high by my standards. I think the real repo rate should be a positive, of course, but it should be in the range of 1.25 to 1.5. If the real repo rate is 1.25 to 1.5, lending rates, of course, will be much higher. In 2017, when we've had inflation targeting for some time, but for the first time we had a monetary policy committee. Suddenly, in the first 10 months of 2017, the real repo rate has been about 2.8 to 2.9. Of course, with this month's inflation uptick, the average for the 11 months will be going down a bit, but it still stays as high as 2.6. So we've had an unusually hawkish monetary policy committee that has kept interest rates extremely high. And that is one very important factor, I think, that has not allowed the kind of growth that we might otherwise have seen. The second factor, of course, is, we all talked about demonetization. I don't want to bore you more with it, but I think the lingering effects of demonetization is still there. We still don't have data, of course, from the unorganized sector, so the effects could actually be much bigger. And we've also seen that demonetization has actually hurt exports and led to a bigger surge in imports than would otherwise have been. And the third factor, of course, as you all know, is the rollout. It may not have affected the organized companies, and in FICCI we've been looking at surveys on this. It hasn't really, in fact, it may have benefited some of the organized sector because the competition from the unorganized sector and from the SMSE sector has actually weakened because they've gone weaker. But clearly that has been a factor that has also held back economic growth in this country. Now, you might say, well, interest rates are not that important, and some of you may even have seen it in your own areas of business. But I think, and I go back to the point I made about India being more or less an open economy, is that when you keep interest rates very high and you have large inflows of capital of the amounts that you're seeing in this little handout as well, then it starts to strengthen the rupee. And the real exchange rate, which economists call, there's the nominal exchange rate, 64, 65 rupees to the dollar. But when you factor out inflation for yourself versus your trading partners, you have something called the real exchange rate. And if you follow the RBI's, say, 36 country trade weighted exchange rate, or even this, they have two indices, the 6 country and the 36 country. Either one of them, our real exchange rate has appreciated considerably in this period. Now, I've been doing research at NIPFP on what drives private investment. This is one of my areas of research. And I've looked at corporate investment, non-corporate investment. More than the real interest rate, what affects investment behavior in India, and we've been looking at data from 1980 onwards, is actually the real exchange rate, not so much the real interest rates. If the interest rate goes up 1 or 2%, it doesn't drive investment behavior as much as the real exchange rate does, because the real exchange rate makes your exports much more competitive. It also makes your you get much more imports coming into the country, and that hurts competitiveness in the domestic economy to a much greater extent. So these three factors, I think, have actually hurt us very, very deep, very sharply in 2017, and by my estimates, have brought down India's growth rate in 2017 by as much as probably 1.5% of percentage points. So if our average growth rate turns out to be 6.5 in 2017, we could have had an 8% growth in 2017 were we not to have had to deal with these. Of the three, I think the interest rate policy and the demonetization were unnecessary wounds that were inflicted on us. The GST, of course, in the long run is probably a beneficial thing over the medium term once we get through all these problems. Now, what do we need to do in the coming year? People tell the finance minister, sir, we are all fine. We've just had a Moody's upgrade. We've jumped up on the ease of doing business. We just have to complete these reforms, and the economy will recover on its own. But it won't, because if you look at export growth, we've had an uptick in export growth, but given where the global economy is, most of the other countries in our region have seen a much bigger surge up in exports. So even if the exporters get through this temporary GST problem that they are facing on their refunds, I think the fact that we remain very uncompetitive in international markets will be a factor next year. We have private consumption still remaining down, and if the RBI continues a very hawkish interest rate policy, I don't see much activity there. Agriculture markets, agriculture incomes are also suffering very deeply, and we need some real reforms there, like agriculture produce marketing liberalization. We would be better off if we shifted, of course, also rural infrastructure. So I don't see a big uptick in private consumption next year. I also see that to meet the fiscal target, if Mr. Jaitley says he was going to meet the 3.2 fiscal target, and GST revenues are coming down, and he has to make up, of course, I think he's going to have getting more from divestment this year, but still, I see tightening in the first quarter of 2018 in order to meet his fiscal target. So government spending, which was driving growth to some extent, is going to get constrained. And really, I don't see any clear engines out there. Private investment, all my research indicates that a big driver is the twin balance sheet problem, that the private credit is actually the lowest since 1993. We had 2.6%, I think, last month, which is the lowest that we've had in private credit growth since 1993. So, and it's going to take them some time to deal with this banking mess that they have inherited. I'm very positive on the recap announcement that the government has made, because I think, we were running around in circles because we had recognition, we had some resolution, but without a recap program, we would not, and a reform program to go with it, we would not have been able to solve this mess. The 2.2 crores that he has set aside for this, roughly $32 billion, is small compared to the size of the problem, which is probably around $200 billion. But nevertheless, it's a very big, significant step that he has made. Now, they've also announced a very big infrastructure program, ports, roads, airports and things like that, 6.9 crores over lakh crores over 5 years. But given the fiscal situation, I don't see the money. So I have been pushing for a much more aggressive privatization program of state-owned enterprises. We have roughly $500 billion in assets in PSUs. So if we take the 7 biggest PSUs out, the Maharatnas, we still have about $300+ billion sitting in 200 other companies. I'm not even counting the thousands of PSUs at the state level. So if we do a very aggressive privatization program over a 10-year period of roughly $250 billion and put that money into the NIIF, they've created the National Infrastructure Fund, and then draw in another $250 billion of private capital, crowd it in, Then we have $500 billion, roughly 2.5% of GDP every year, extra that can go into infrastructure spending. All our research shows that more infrastructure spending draws in more private investment into the economy. So I think that is an area where they need to push. But this will take some time, and therefore a private investment recovery, although Mr. Ambani announced a very positive that he's starting a capex cycle in Reliance, I think a private investment recovery is still a year or so away, and probably people will wait for the 2019 election before they really go in big. So I think next year is a very difficult year, and therefore a ho-hum budget will not cut it. And therefore I think it's very important that he help drive the economy. Corporate taxes are an area which they have already announced that they would go to 25%. We have given the finance minister a lot of research from around the world to show him that it is possible to actually lower corporate taxes and yet not lose corporate tax revenue. We've also given him evidence that new startup activity and the size of startup activity is directly affected by the corporate tax rate. So now that Mr. Trump has announced a reduction to 20%, which will come on January 1 probably, unless they shift it to January 1, 2019, that discussion is still going on. The average for all advanced economies is already around 22 to 23%. So even at 25%, we would still be above, although probably the effective tax rate for us at 25, if we were to drop it suddenly to 25, would probably be in that ballpark of 22, 23%. So I think this is a big signal that he could give in the budget on pushing, economic activity. Then one last point I want to make. I could talk on these issues on and on, but I just wanted to make one more point. Ease of doing business. Now, I was at the World Bank for 25 years, so I know that index very, very well, as may some of you. It is an important index, and it is important that we moved up 30 points on that scale. But it is important to keep in mind that that index is a reflection of a lot of paper reforms, right? I mean, for example, there's a huge disconnect between that index and when you do business surveys. For example, if you do business surveys and you ask them, how long does it take you to do construction permits? They'll give you a very different answer from the number that sits in the World Bank's ease of doing business. So it's not a bad index, but it has a lot of flaws in it, and it doesn't really reflect, as probably you guys know better than I, what's really happening on the ground, right? So, and given that we are facing increased imports, particularly from China, we have a trade deficit of 50 billion with China. We've signed a whole lot of free trade agreements which are actually hurting us at this point. Our exports are not picking up. I think this government should announce a major, what I call a major trade and industrial policy that will signal how India over the next 5 years will become much more competitive. And I can go into details with you of what that would contain. Deregulation in many areas. Your businesses probably face conflicting regulation, particularly in the financial sector. You have so many regulators you have to deal with, and now with GST coming in as well, it gets very complicated. So I think we need a major deregulation push. We need a new trade and industrial policy. I'm told that the new Commerce Minister is working on it, and from FICCI's side, we have an entree, so we are also pushing, and we will be providing them a lot more information on this. But I think something along those lines, if we are to not have another bad year in 2018, is needed to boost the spirits, to make sure that we don't end up with another sub 7% year for 2018. It is possible that we could go above 7%, but just treading water will not do it. They can tread water in the next budget because that will be close to the election, but this budget is too important for the government to tread water, because we could risk going under 7% for another year unless some push is made in this budget to get us over to 7 to 8, meaning 7.5% or so. It is possible, so we'll wait and see on February 1 what gets announced. But the elements of it should be reduced corporate tax rates, new trade and industrial policy, a faster resolution of the banking mess, and then also getting rid of a number of state banks. I don't think we need 19 state banks. We probably need 4 or 5 at best. So very aggressive push on that would be, but at least the 2.5 crores that he has, lakh crores that he has, he would be better off putting it into the better public banks rather than wasting it and spreading it across all 19 of them. Thank you very much. I don't know if I've cleared the smog for you, but without a government push, 2018 could be a difficult year for India. Thank you.